I have some long-term bond funds and single issue bonds. Should I keep holding them even though they're performing so poorly, or should I just sell them at this point, cut my losses, and move to something short-term?
Okay, so let me describe what those are just real quick. So a long-term bond fund means there's a grouping, a basket, a collection of long-term bonds all in one portfolio. You buy it under one ticker symbol. You can buy it as a mutual fund. You can buy it as an exchange-traded fund. They're very similar, just different in the way that they trade and what
And they
have you.
usually have some sort of commonality. So, like a
Yeah.
long-term bond fund will be anything plus 10-year duration.
Yeah, so maybe it has, all bond. It could be all government, it could be corporate, it could be mixture, whatever it is. But, the question was long term, so more sensitive to interest rate changes and much more fluctuation. You get far enough out on the treasury spectrum that moves as much as stocks,
Yeah.
right? The EDV, the extended duration Vanguard Treasury ETF. I think it has a standard deviation that's actually slightly higher than the S&P 500. So, it's more of a stock trading mechanism. And so obviously that doesn't have a maturity date. So the price can keep coming down if the market continues to struggle.
Hmm.
Yeah, you're making more yield, but you're losing more on the price depreciation, and so you're losing altogether. A single issue bond would be like one treasury bond or one bond at Ford or
Yeah.
wherever, right? And the advantage of those is that although the price can fluctuate, when they come due, you're going to get what's called par value, which is usually $1,000 a
Yeah.
bond, right? And so even if it's worth 700 now, if you hold on to it, it'll be worth 1,000 in the end. Um, and so we have a green signal right now on our fast signal,
Hmm.
and on our bond market. And so I would be interested at this point in kind of holding on to my long-term bonds until that turned to red, which could happen tomorrow. We've been getting it flashing back and forth, but
Yeah.
there is a shot here. We're right at a very heavy support point. The market has already had a lot of fall. It's very stretched to the downside, right? So maybe wait until a red signal comes through on the bond and then deal with it. However, there are some caveats to that. It depends on where it is.
Yeah.
Yeah. Do I have a big gain for some reason because I've had it for a long time and I would have to pay a capital gain? That would change maybe my calculus as to whether I sell it. Do I have a loss? Because that might be advantageous to take it.
Yeah. Is it in a taxable account or a tax deferred or tax-free account?
Yeah, it could be in my IRAs and the tax consequences don't matter. I'm just looking at purely return basis. If it's in my IRA, I probably keep it for now. When that signal right there goes to red, I probably sell it. I probably keep my single issue bond, especially if it's got a decent yield. If I
Especially if you trust the company
Right,
too.
exactly. If you feel like they're going out of business, that's a different deal, But if it's a treasury or something, a 20-year treasury or whatever, because we just had the 20-year treasury auction, last week?
Yeah.
Went pretty well. So, somebody bought a bunch of 20-year treasury bonds. And so anyway, that might be worth keeping around as far as that goes. Long term, if you look at the bond market as a whole, we had a massive run up in the 2020 bubble, and then a big downturn right back to where we were. Right, so it looks like a horrible market, but everybody forgot how good it was prior to that.
Yeah. That 2020 run was
Yeah,
massive.
so it's just like for years we were going kind of sideways with the price. We went straight up and kind of across, and now we've come straight back down. We're really back to where we were price-wise prior to the pandemic. I don't see that as a terrible thing. That's pretty normal. I wouldn't worry about it too much, but because I think we're there. I saw a couple of articles talking about the bond market and how you look at future expectations. So 10-year expectations for inflation is at about 2.43%. And there's a factor that you multiply. And so 10-year treasury should be about 5.17 to 5.4. And we're just now hitting like 5. So it might be a little bit more yield gain. When the yield goes up, the price goes down,
Hmm.
right? So, but I think we're pretty close to where we should be for this inflationary environment. If things change and we get back to a scenario where inflation gets really hot again, which I do still consider, and I've been talking about this for months, the bigger threat. It's a bigger threat for reinflating, inflation
Hmm.
than it is for a recession, in my opinion, and that's proven to be true. Recession, nobody's talking about anymore. They're now talking about reinflating inflation, which is what I was talking about back in May. I still think you can kind of feel it. Things are kind of hot.
Hmm.
Uh, you know, it's kind of interesting how many people don't believe that, but look at the consumer spending, and it's going pretty well.
Yeah.
And job market's really tight. Unemployment's low. Lots of new jobs being created. Lots of new jobs still open. What is it? 8.4 million jobs open, 9.9 something.
Yeah.
Forgot that number, but so things aren't too bad. And of course, that's why you want to watch that bond market closely for a little while here and see if how this plays out.